Hello everyone, welcome back to the Payless Heights Channel 4 Financial News. We have a new format and a new show to share with you. With me is Paul Munico with Ameriprise Financial Services, and he's going to be co-hosting the show with me. And of course, I'm Ron Jankowski with Channel 4 with Payless Heights. Paul, how about we share a little bit with the viewers as the type of information we're going to be sharing with them on the financials?
Yeah, I'm excited for the new show for ourselves and for the viewers at home. And Ron and I have spent time debating how to run this show going forward. And what the format we've come up with is we're kind of scouring the news for what is important trending in the news now. And Ron's going to ask me one or two questions in the first half of the show about them, and I'm going to answer them as best I can. And then we will go on to the second half of the show like we had done in the past, where we'll talk more specifically about one individual topic. And also, Ron will give you updates on just the current capital markets and where they stand for the year.
Okay, can we start with the first question that I have?
Absolutely.
Okay. Paul, the first quarter season has begun, and what can the investors really expect at this point?
Yeah, so earnings season has begun, and that's what the markets are anxiously looking towards now to see how earnings are going to come in. And as the Q1 earnings release ramp up, we need to take a look at what's expected and what's driving performance. Overall, companies of the S&P 500 are expected to see earnings per share decline by about 4% versus year-ago levels, which could be the first year-over-year decline for the index since the second quarter in the year 2016. For various reasons, we believe the actual results stand a chance of ultimately creeping into positive territory, however. Sales per share, meanwhile, are expected to post a 5.2% year-over-year increase. That would be very good. Investors should take comfort in that. Although earnings declines are widespread across the industries, much of the pressure appears to be related to what could be relatively temporary factors. Most notably, as we enter 2019 with low commodity prices amid fourth quarter's global recession fears. So West Texas Intermediate crude, for example, started the year at 15-month lows, which was below $50 a barrel. As we look ahead, the S&P 500 earnings per share for Q2 are expected to be generally flat. However, given the recent resurgence of commodity prices and slowly rising optimism for a trade deal, we could see estimates rise somewhat against their normal pattern. During any given earnings release season, estimates for the next quarter typically decline as managements look to quote-unquote lower the bar.
All right, Paul, I have one more question, and it's about the International Monetary Fund. Now, it's lower, and its outlook, again, is lower. So what does that really mean to people that are investing in small-time investors? What should they be expecting on something like this taking place?
Yep, so the International Monetary Fund, otherwise known as the IMF, as you said, Ron, again lowered the global outlook, but it's possible the worst could be behind us. So just recently, the IMF released its World Economic Outlook quarterly update. As it was generally expected, the organization once again lowered its outlook for 2019 global real economic growth, making it the third straight quarter the IMF forecasters have cut their outlook for the year 2019. It could be their last cut, however, as some of the negative influences that have been impacting growth could be moving into our rearview mirror. Let's consider the U.S.-China trade dispute has had a negative impact on global growth over the last year, as the two countries combined represent about 40% of global economic activity. A deal and resulting retraction of tariffs could very well improve momentum over time. The hefty stimulus plan currently being deployed by China's central government should help as well. Also, in 2020, an end to the temporary U.S. government spending approved for 2018 and 2019, and we're talking about $150 billion per year, has long been expected to be a major drag on the U.S. Real GDP prospects. That's about 0.8% in our estimates. However, some in Congress have already proposed continuing at least some of this added spending into 2020, a prospect that could see bipartisan support as we head into a presidential election year. So a lot going on globally as well, which of course has an impact on our markets. And speaking of our markets, I know you've got the totals for how the markets have been performing roughly year to date.
As of April 16th, the world capital markets are as follows. S&P 500 is a plus 16% approximately, and I'm saying the word approximately because there's always and change.
It changes by the second. I mean,
yes,
as the markets move, those numbers
exactly.
change.
The NASDAQ is actually up 20%, and the Dow is up 13%. Interesting, the WTI crude is up 40%. So what an impact that is to oil and, of course, gasoline prices. And I thought one more, the net gas is a minus 11%. Is there anything you could add to that, Paul?
Well, crude was so depressed at the end of 2019, so it had to gradually move up. 40% is a steep incline for crude oil. Already we've seen this year. The drop in natural gas is somewhat seasonal and a bit expected in that approximate 11% drop. That's more cyclical, so that isn't completely out of line with what we normally see.
Okay, well, it's interesting to hear the history behind some of these things, but it's interesting also to see all the markets are basically up. They're in the teens, or the NASDAQ is up in the 20% plus. Very, very interesting what has happened here. Unless you have something more to offer with information, with the financial news, I was going to switch to our next show.
Great.
Called The Money Show. And it's your money that we're going to be talking about, and that's the name of the show. We would like for you to stay with us. We'll be right back. And we'll be talking about some interesting things that, as an investor, you might want to consider with discussing with your financial advisor. Stay with us. We'll be right back. Thanks for staying with us. Our new show called Your Money. Hopefully you can get some suggestions from us that may help your portfolio that you should be reviewing with your financial advisor. We don't want you to take what we're talking about and just apply it. You should be discussing this with a professional person to make sure your objectives are reached with your profile. Paul is going to be sharing a lot of information, and I want to start with something that's going on with the trade tensions. And a prominent economic story of the past year has been growing, a tide of trade disputes across the globe. And the U.S. is at the center of it, most notably with China, which means investors are often subject to daily headlines debating possible implications for global markets and the economy. But there are reasons for investors to be concerned. What are they, Paul?
Yeah, so the short answer to that is that trade tensions are nothing new. And our country has dealt with impacts of international negotiations many times over. Yet as trade becomes increasingly global, it's important for investors to understand the current environment and what may be ahead for the markets. So let's dive into this a little more, starting with a quick history lesson to provide some perspective on today's trade environment.
Paul, trade issues are really nothing new, are they?
They are. There's nothing new there. Challenges with trading partners for our nation go back to its founding. The Boston Tea Party of 1773 was a protest against taxes imposed by Britain on a number of products used by colonists. Fast forward to when the U.S. economy struggled during the Great Depression of the 1930s, and Congress imposed the Smoot-Hawley tariff. That legislation was designed to protect American jobs, raising duties on over 20,000 imported goods. Many of the targeted countries countered with retaliatory tariffs. As a result, trade activity dropped dramatically, contributing to global economic turmoil. The U.S. economy picked up with the onset of World War II and emerged as a dominant force in global trade. However, in the years that followed the war, Europe and Japan rebuilt their economies, and by the 1970s emerged as a trading powerhouses. Now, this transformation in many ways set the stage for increased global trade as we know it today.
And trade really has become a global thing now, hasn't it?
Yes, it has, and it's the driving force behind increased international trade, which is kind of what we talked about in the first half of the show a little bit. And that was the belief that benefits would extend to more people across the world. Landmark treaties like the North American Free Trade Agreement, otherwise known as NAFTA, established in 1994, that was between the U.S., Canada, and Mexico, highlighted an extended period of open borders for the movement of goods and services. The European Union, created in 1993, represents another form of trade agreement, reducing barriers to the movement of goods. Yet a common concern with many treaties is the belief that they benefit some industries while leaving people and others behind. So for example, many U.S. farmers benefit from agricultural exports to other countries. And the U.S. generally has a trade surplus when it comes to services it supplies internationally. On the flip side, in the 1970s, for instance, Japan's automobile industry rose, while U.S. car companies struggled. We've seen similar trends with industries like textiles and steel manufacturers. The current trade deficit shows that the U.S. economy is more dependent on imports than it is on exports. The last time the U.S. ran a trade surplus was in 1975. Since then, the trade deficit has risen significantly, peaking in 2006 at $761 billion. That's according to the U.S. Census Bureau's Economic Indicator Division, before dropping and remaining fairly consistent between 500 and 600 billion.
Paul, should one be concerned about tariffs? Is there an impact on investors?
Well, if we fast forward to today, I mean, that was our history lesson in the past. If we move to today, where we find ourselves at another crossroad with trade, take, for example, the recent implementation of tariffs on a variety of international products. These tariffs are aimed in part to help domestic industries that are losing business to lower cost goods from overseas. A similar goal of past tariffs. Whether these industries and their workers will benefit over the long run remains in question. There are some other factors that bear watching. The primary concern for investors is whether tariffs will create negative economic consequences for the targeted industries in the U.S. or the global economy. So recently, trade tensions have had an impact on investor sentiment, with more people becoming cautious about the state of the global economy. In many instances, these trade disputes can be a contributing factor to market volatility. This is because markets do not like the uncertainty that happens when global powers are negotiating.
So, Paul, what does one or all of this trade history impact? How does this impact somebody who is trying to invest in particular investments and maybe stocks, that type of thing?
Well, the key takeaway is to keep an eye on trade developments and not to overreact to daily headlines. Remember that trade policies are just one of many factors likely to impact the economy and markets. Maintaining a diversified portfolio that is reflective of the level of risk you are willing to accept to reach your own financial goals is one of the best defenses to all types of market uncertainty.
Oh, that was a lot of information, Paul. And Paul, since you are now representing another company, Ameriprise Financial Services, I'm going to let you close with your information should any of the viewers have some questions about the things we've talked about, and maybe they may ask for us to share other information to maybe supply them with more financial
Yes.
to make decisions on their investments.
Absolutely. So in shows in the past, I've always signed off as Paul from Wells Fargo Advisors. As Ron mentioned, I have changed to a firm, Ameriprise Financial, also located in Orland Park. I'm proud to be working there and representing them, and proud to offer everything that they offer to clients as I was at Wells Fargo. As always, you can feel free to reach out to me directly with any questions or concerns you have on today's topic or anything else that may affect your portfolio. Feel free to reach out to me directly at 708-226-3412.
Okay. Well, Paul, I enjoyed co-hosting with you. Hopefully we've covered a lot of information that was of interest to the investors, and we will pick up again next week and supply them additional information as the market changes.
Great.
Okay. So for those that are watching us, if you have any question, please give Paul a call to the number that he gave you. For Paul Munichel with Ameriprise Financial Services, myself, Ron Jankowski with Channel 4 and Palo Sites, we wish you a good investment day.